All right, hello and welcome. If you've ever glanced at the stock market and thought, whoa, that looks complicated, you are in exactly the right spot. Over the next few minutes, we're going to pull back the curtain and break down the absolute first steps into the world of stock trading. Let's dive in.
So this is the big one, right? The question that gets everybody interested in the first place. And the short answer is yes, it's absolutely possible. But, and this is a big but, it's not a magic trick. It all starts with getting a handle on the fundamentals, and that's exactly what we're going to do right now.
Okay, so where do we even begin? Well, we have to start at square one, with the most basic question there is. Before we can get into any of the cool stuff like charts or strategies, we've got to be on the same page about what trading even means.
At its very core, it's this simple. You buy a stock at one price because you think its value is going to go up. Then, when it does, you sell it. That little difference between your buying price and your selling price, that's your profit. The key thing here is that we're talking about shorter-term moves, not necessarily holding on for years and years.
All right, we know what trading is, so what's the first actual step you need to take to get in the game? Well, you need a way into the market, and that all starts with opening the right kind of account. Let's walk through what that looks like.
The whole process is actually way more straightforward than it sounds. First, you pick a stockbroker. Then, you'll do a quick identity check called KYC. That's just a standard process to prove you are who you say you are. After that, you'll link up your bank account so you can move money in and out, and once that's all set, your broker opens two really important accounts for you. A trading account, which is what you'll use to actually hit buy and sell, and a DMAT account. Just think of the DMAT account as a digital vault where your stocks are kept safe and sound under your name.
Okay, so you've got your account. Now the real fun begins. I know, looking at a stock chart for the first time can feel like you're trying to read some secret code. But once you learn a few key words, it all starts to click. And our very first words are going to be candlestick patterns.
You see all those little red and green bars on a chart? Every single one of them is a candlestick. And each one tells a little story. It shows you the price where the stock opened, where it closed, the highest point it hit, and the lowest point it hit, all within a set time. Could be a minute, could be a day, whatever you set it to. They are literally the building blocks for reading any chart.
We're going to kick things off with two super common and really important patterns, the doji and the hammer. Each one gives you a clue about the battle that's happening between the people buying and the people selling. One tells you it's a tie, and the other signals that one side might have just won a major battle.
Now, check out the doji. The fascinating thing is its shape. See how the main body is just a tiny little sliver? That means the stock opened and closed at almost the exact same price. All day long, buyers and sellers were in a tug-of-war, and in the end, nobody won. When you see a doji, it's like the market is just pausing, totally unsure of which way to go next.
The hammer, though, tells a completely different tale. This is a comeback story. That long tail at the bottom shows that the sellers tried to push the price way, way down, but then bam, a whole bunch of buyers jumped in and pushed the price all the way back up to close near the top. When you spot a hammer after prices have been falling for a while, it can be a really powerful sign that things might be about to turn around.
So, we've learned a couple of words with those candlesticks. Now let's learn some of the grammar of chart reading. We're going to look at two of the most important concepts out there, support and resistance. These help you see the bigger picture, the whole structure of the chart.
Honestly, this is the simplest and best way to picture it. Support is like a price floor. Every time the stock price falls to that level, it tends to bounce back up. Why? Because that's a level where buyers think, hey, this is a good deal, and they start buying. Resistance is the total opposite. It's a price ceiling that the stock has a hard time breaking through, because that's where sellers often decide to take their profits.
So how do you find these levels? It's pretty visual. You just look at a chart, find the lowest points where the price has bounced up a few times, and draw a straight line connecting them. Boom! That's your support. Then you do the same thing for the peaks where the price kept getting stuck. Draw a line there, and that's your resistance. These lines give you a kind of roadmap for where the price might turn.
Wow, okay. We've actually covered a ton of ground in just a few minutes, haven't we? We've gone from the big idea of what trading is to the practical steps of getting an account, and even started reading the visual language of a chart. This stuff right here, this is the foundation for everything else.
So, let's just do a quick recap. You now have an amazing beginner's toolkit. You get what trading is, you know the exact steps to open your accounts, and you can now look at a chart and spot two major candlestick patterns and find those basic support and resistance levels. Seriously, that is a huge first step.
Look, this was all about giving you a solid launch pad. But the journey of learning to trade, that's an ongoing thing. So the real question isn't if you can learn, it's what do you want to learn next? Are you curious about more candlestick patterns, different kinds of tools and indicators, or maybe the art of managing risk? Your journey is just getting started.